Usually, when we look at a company's financial report, the math is, well, it's pretty straightforward.
Right. It's basically like Newtonian physics.
Exactly. I mean, it feels very cause and effect.
Yeah.
A company sells more widgets, their revenue goes up, the investors cheer, and, the stock price climbs.
Yeah, or you get the exact flip side.
Right. They sell fewer widgets, revenue drops, investors panic, and the stock plummets. We just expect the scoreboard to reflect the reality of what's happening on the field.
It's the basic gravity of the stock market. You don't really expect an apple to fall upward from the tree.
Which is why today's deep dive here on Talk Tickers is going to probably melt your brain a little bit.
Oh, it's a wild one.
Yeah, because we are looking at a situation where that financial gravity seems to have completely broken down. We're doing a forensic teardown of KE Holdings.
Better known to most people as Beike.
Right, Beike. They are just the absolute behemoth of the Chinese real estate platform world. And before we get into the weeds, let's start with a summary of the results from their Q4 and full fiscal year 2025 earnings call.
Yeah, from back on March 16th, 2026.
Exactly. We're looking at the actual transcripts featuring the CEO Stanley Peng and CFO Tao Zhu. And the numbers paint a very, very stark picture.
Brutal might honestly be a better word for it.
Brutal definitely works. Yeah. Let's look at the top line realities here. Gross transaction value, which is, the total value of all the real estate sold through their platform, that dropped 36.7% year over year.
Down to 724.1 billion RMB.
Right. And total Q4 revenue fell 28.7% to 22.2 billion RMB, which is roughly 3.2 billion US dollars.
It's a massive contraction.
Yeah. Their core transaction revenue for existing homes plummeted 39%, and new home transaction revenue just cratered by 44.5%.
And it wasn't just the top line taking a hit either. The bottom line completely missed the mark.
Did it ever?
Yeah. The company reported a GAAP earnings per share of just 1 single US cent.
Wow.
And even when you look at their non-GAAP adjusted EPS, which, smooths out some of the one-time accounting items, they came in at just 7 cents per share.
And what was the market expecting?
The consensus was clustered right around 11 to 12 cents. So they missed profit expectations by a solid 4 to 5 cents.
Okay, so here is the setup, right? This is the paradox we're going to explore today for you listening. A massive real estate company reports an earnings miss.
A pretty big one.
A huge one. Its core housing revenue drops by nearly 40% year over year. The broader macroeconomic market they operate in is, well, it's actively sinking.
Yeah, it's not looking good.
By all traditional logic, Wall Street should have just taken a sledgehammer to this stock. And yet, stock went up.
It really did.
From the close just before the earnings to the close after the release, the stock gained 1%, with initial spikes over 3%.
And the trading volume absolutely exploded.
Right. It doubled overnight to over 6.3 million shares. So how does a company report that its core engine is basically stalling out, and the market responds by aggressively buying the stock?
Solving that mystery really requires us to look past the raw turnover of housing units. Because, for years, investors viewed Beike simply as a China housing beta.
Meaning what exactly?
Meaning, if you thought the Chinese housing market was going up, you just bought Beike. If you thought it was going down, you sold it. They were essentially just a proxy for the sheer scale and volume of Chinese real estate.
Ah, okay. So they were tied to the macro trends.
Completely. But what this earnings call signals is a definitive end to that era.
Really?
Yeah. The market is rewarding them because they're actively rewriting their own DNA. They're pivoting from this volume-driven property broker to a highly defensive, diversified residential services platform.
And we are going to uncover exactly how they are managing that pivot, how a company navigates a historic multi-year property downturn by shifting away from a growth at all costs mindset.
Right, moving to one obsessed with efficiency.
Exactly. Efficiency, integrating AI into their core workflows, and prioritizing capital returns.
It's a massive shift.
So whether you are in tech, running a small business, or just fascinated by high-level corporate strategy, this really is a masterclass in surviving a shrinking market.
You definitely don't have to care about Chinese real estate to learn from this.
Right. It's about a management team that is figuring out how to swim when the tide is just rushing out.
And the first place we have to start to understand that stock price bump is it's the capital return strategy.
Let's dig into that.
Because investors looked at the top line miss, they saw the 40% drops in core housing, and they effectively shrugged.
They just didn't care.
Basically, they looked past the income statement and went straight to the balance sheet. Management delivered on the two things modern investors are demanding right now:
Which are?
cash in hand and ruthless cost discipline.
Okay, let's put some hard numbers to that cash in hand because the scale of it is actually staggering. In 2025, Beike executed massive share repurchases.
Huge buybacks.
Yeah, buying back $921 million worth of their own stock. That is a 29% increase in buybacks compared to the previous year.
Which represents about 4.1% of their total shares outstanding. Just retired.
That's a lot of equity to take off the table.
Yeah.
And on top of that, they announced a final cash dividend of $300 million.
Yeah.
So if you add that up, that is $1.22 billion handed directly back to shareholders in a single year.
And that 1.22 billion figure is really the key to the whole psychological shift in the market.
Why is that the magic number?
Because that amount represents about 170% of their total non-GAAP net profit for the year.
Wait, I want to stop and highlight the math there because it literally sounds like a typo.
It really does.
They gave back more money than they actually made in profit for the year. How is that structurally sustainable? I mean, are they just liquidating the office furniture to keep the investors happy?
It looks alarming until you check their cash reserves. They ended the quarter sitting on roughly 55.5 billion RMB.
Which translates to what, like billions of US dollars?
Exactly. Billions in cash, cash equivalents, and short-term investments. That is a fortress balance sheet built during the boom years of Chinese real estate.
Ah, so they hoarded cash when times were good.
Precisely. They accumulated massive retained earnings when the market was on fire. Now that the market is frozen, they are deploying that capital to reward investor loyalty.
It makes me think of a ship taking on water.
Right.
If you are a passenger and the hull is leaking, meaning the core housing market is sinking and taking transaction volumes down with it, you usually panic and run for the lifeboats.
Right. That's the normal reaction.
But in this case, the passengers aren't panicking because the captain is standing on the deck saying, yes, the ocean is rough and yes, we are taking on water, but look at all this gold we have stored in the cargo hold.
And I'm going to hand it out.
Exactly. I'm going to start handing it out to anyone who stays on board. The buybacks are essentially the captain buying the tickets back from the panicked passengers at a premium.
Which increases the percentage of the gold owned by everyone who stays.
Right. It's a genius way to prevent a mutiny.
That analogy highlights the exact mechanical effect of a share repurchase program. By buying back 4.1% of the outstanding shares and retiring them, the company is artificially supporting its future earnings per share.
Because the denominator gets smaller.
Exactly. Even if their total net income stays flat or even drops slightly next year, the profit is being divided among fewer shares. It is a manufactured yield.
And it completely changes the narrative.
It signals a massive shift in how technology and platform companies are being valued today.
I mean, contrast this with 5 years ago, right?
Yeah.
In the era of zero interest rates, it was all about growth at all costs.
Oh yeah, top-line obsession.
If you were a platform company, you were expected to show 30, 40, 50% revenue growth every single year. And if you didn't hit those vanity metrics, the market punished you relentlessly.
But the rules of the game have entirely changed. We are in a higher interest rate environment globally, and specifically in China, we're looking at severe macroeconomic headwinds in the property sector.
So investors just aren't buying the growth story anymore.
They're not willing to fund unprofitable growth, or even growth that requires massive capital expenditures with uncertain future returns. They are valuing stability, mature cash flows, and shareholder yield over nominal expansion.
So the market reaction to Beike's earnings is basically proof that if you can demonstrate a streamlined cost structure and a willingness to, open the vault for shareholders.
Wall Street will forgive a shrinking top line, absolutely.
But, I mean, there is a limit to how long you can just pay people to stay on a sinking ship. Eventually, you have to actually fix the ship or find calmer waters.
You can't just buy back your way to infinity.
Right. Let's look at the macro environment they're actually operating in, because the structural cooling we are seeing is historic.
It's pretty grim.
Yeah. In February 2026, new home prices in China were down 3.2% year over year. Now, that wasn't a blip. It was the 8th straight monthly decline.
And the projections aren't much better.
No. Projections suggest home prices will drop 4.0% for the full year of 2026. With stabilization not expected until 2027 at the earliest, we are talking about a multi-year contraction of one of the largest asset classes on the planet.
And management is acutely aware of this. CEO Stanley Peng explicitly stated on the call that the company holds a neutral market view for 2026.
Neutral market view. That sounds like corporate speak.
It is. In executive parlance, neutral market view basically means do not expect macroeconomic tailwinds to save us. We are entirely on our own.
Wow. Hi.
To survive, he detailed a transition from a scale-driven model to an efficiency-driven model. And this really requires understanding the difference between nominal capacity and effective capacity.
Okay, break down that difference for us. Because historically, the real estate brokerage industry was a pure numbers game, wasn't it?
Historically, success was completely defined by nominal capacity. It was an arms race of sheer presence.
Like having a storefront on every corner.
Exactly. Whoever had the most physical storefronts and whoever had the highest headcount of agents won the market share. You essentially just carpet bombed the market.
Because there's so much volume.
Right. If the real estate sector is booming and transaction velocity is incredibly high, you just want the widest net possible to catch all those transaction fees. That is a scale-driven nominal capacity model.
But when the market shrinks, that massive net suddenly becomes incredibly heavy. I mean, all those storefronts have lease agreements. All those agents have base salaries and administrative costs.
And maintaining idle capacity destroys your profit margins.
Which is why the pivot to effective capacity is so critical. They are shifting the focus away from the gross number of agents they have to the specific unit economics and productivity of the agents they keep.
Exactly.
But I would push back on that phrasing a bit. I mean, every company that goes through a massive downsizing claims they are focusing on efficiency or trimming the fat.
Sure.
Is this just a dressed-up way of saying they are firing the bottom 20% of their workforce, closing underperforming stores, and shrinking the footprint of the company?
Well, there is absolutely a contraction element to it. I mean, the CFO noted some one-off expenses in Q4 specifically related to store closures and severance.
People are losing their jobs.
Yes. But to call it just a downsizing misses the architectural changes they are making to the platform. Management refers to this as improving their structural matching efficiency.
Structural matching efficiency.
Right. They aren't just making the engines smaller, they are fundamentally changing how the fuel is injected into the cylinders.
Okay, let's get into the plumbing of that. What does structural matching actually look like on the ground?
Under the old model, an agent would basically scramble for whatever leads they could find. And the platform would distribute inquiries somewhat evenly, or maybe based on whoever paid for premium placement.
Just a free-for-all.
Basically. But in a falling market, a low-quality lead matched with a mediocre agent results in a failed transaction, wasted time, and a frustrated client.
Right, because buyers are much more hesitant now.
Exactly.
Yeah.
So structural matching means the platform is actively using data to grade both the buyer and the agent and routing them accordingly.
Wait, so they're scoring the intent of the buyer, like how serious they are?
Yes. They look at the data. How many listings has this person saved? Have they completed any financial pre-qualification steps? Are they consistently logging into the app every day, or are they just a casual browser?
Okay, and what about the agents?
Simultaneously, they are grading the agents on a hyper-local level. Not just, is this a good agent overall, but does this specific agent have a proven track record of closing 3-bedroom apartments in this exact district under current market conditions?
Oh, wow. So they are matchmaking.
Highly targeted matchmaking. By taking the highest intent buyers and algorithmically pairing them with the most effective agents for that specific property type, you drastically increase the conversion rate.
So it's the difference between blindly casting a huge net into the ocean and just hoping a fish swims into it.
Right.
Versus using a highly targeted sonar system to drop a single line exactly where the biggest fish is swimming, right in front of your most experienced fishermen.
That's a great way to put it. And the data proves that the sonar approach is actually working. Even against these brutal market headwinds, agent productivity in their core cities like Beijing and Shanghai improved.
Really? Productivity went up while the market went down?
Yeah. The average number of existing home transactions per connected agent on their platform rose from less than 2 transactions in 2022 to more than 3 transactions in 2025.
That is a staggering metric.
Yeah.
I mean, the overall market pie is shrinking drastically, yet the individual agents remaining on Beike's platform are eating significantly larger slices.
Exactly.
They increased individual productivity by roughly 50% over a 3-year period, while the macro environment was literally falling apart around them.
And that increased productivity directly protects the profitability of the company. In their existing home business, the contribution margin reached 40.4% in Q4.
Which is pretty healthy.
Very healthy. It was stable year over year and actually rose quarter over quarter. By squeezing more profit out of fewer sales, they are creating massive operational leverage.
Let's talk about operational leverage, because that feels like the hidden spring coiled inside this stock. If Beike can maintain a 40% contribution margin and stay profitable while the broader market is dropping 4% a year,
Yeah.
what happens to their margins if the market eventually stabilizes in 2027 and starts growing even just 1 or 2%?
The profits would absolutely explode upward
Because the costs are fixed.
because they have eliminated the dead weight of the nominal capacity. Any incremental revenue that comes in from a market recovery will flow almost directly to the bottom line. They won't need to immediately hire thousands of new agents or open hundreds of new stores to capture that growth because their existing effective capacity can handle it.
That makes a ton of sense.
Yeah.
But hoping for a market recovery in 2027 is a pretty dangerous game to play. I mean, you can't just tread water for 3 years and pray the macroeconomic weather changes.
No, you definitely can't.
Which brings us to the lifeline they are desperately trying to build, the non-housing transaction businesses. And the progress here is wild. In 2025, non-housing businesses reached a record 41% of their total revenue.
It's a textbook diversification strategy. Management recognizes that the property transaction market is deeply cyclical and currently in a severe trough.
So they need other ways to make money.
Right. So they are heavily leaning into services that are structurally less sensitive to the actual buying and selling of homes. The two massive pillars here are rentals and home renovation.
Okay, let's tear into the rental segment first. Because on the surface, the growth is phenomenal. It grew 18.1% year over year in Q4.
Which is huge in this market.
Massive. They reached over 700,000 rental units under management, which is up 62% year over year. And perhaps most importantly, this rental segment finally turned profitable at the operating level for the full year.
However, there is a really fascinating accounting quirk hiding in the Q4 numbers that trips up a lot of casual observers.
I think I know what you're going to say.
While the year-over-year growth was strong, the Q4 rental revenue actually dipped 5.5% sequentially compared to Q3.
Yeah. I spent an hour staring at that line item, trying to make it make sense. How do you increase your units under management by that much, turn an operating profit, but see your quarter-over-quarter revenue actually go down?
It all comes down to a deliberate strategic shift in how they recognize revenue, driven by an upgrade to their product model called carefree rent.
Okay.
To understand why this is a positive development disguised as a revenue drop, we really have to look at the plumbing of the old model versus the new model.
Let's do it. What was the old model?
Under a traditional asset-heavy model, a platform like Beike might act essentially as a master tenant or a primary landlord.
Okay.
They would sign a long-term lease with the property owner for, let's say, $1,000 a month. They guarantee that payment to the owner.
So Beike is on the hook for $1,000.
Exactly. Beike then turns around and subleases that apartment to a tenant for $1,100 a month.
So they make $100 spread.
Right. But under general accounting principles, because Beike holds the primary lease risk, they recognize the full $1,100 as gross revenue on their top line.
Oh.
And then they record the $1,000 payment to the owner as an operating expense.
So their top line revenue looks absolutely massive. They are booking $1,100 in revenue every single month for that one apartment.
Even though their actual gross profit is only $100.
And more importantly, that model carries catastrophic balance sheet risk, doesn't it?
Huge risk.
Because if the apartment sits empty for 3 months, Beike is still legally obligated to pay the owner $1,000 a month. They're eating pure losses. It is a capital-intensive, high-risk game of musical chairs.
Exactly. Which brings us to the carefree rent model.
How does the accounting change there?
Under carefree rent, Beike is shifting to a lighter, lower-risk model where they act purely as an asset manager or a service provider. They do not take on master lease.
So they aren't on the hook for the rent.
Right. The tenant signs an agreement where the rent flows more directly, and Beike simply extracts a service fee for managing the property, finding the tenant, and, handling maintenance.
Okay, so sticking with our numbers, let's say that service fee is $100.
Right. Now, instead of recognizing $1,100 in gross revenue, Beike only recognizes $100 in net revenue.
Oh, wow. So from a pure spreadsheet perspective, their revenue just dropped by over 90% for that specific unit.
Yes.
They traded $1,100 of gross revenue for $100 of net revenue.
Exactly. And the CFO noted that by the end of 2025, the proportion of rental units where revenue is recognized on this net basis exceeded 30%.
So a huge chunk of their portfolio converted.
Right. And that massive accounting shift is why the top-line Q4 rental revenue looked like it shrank sequentially.
But the reality is the underlying unit economics are vastly healthier. They are shedding all the vacancy risk. If the apartment is empty, they don't make their $100 fee, sure, but they also don't lose $1,000 out of pocket.
It's a much safer play.
They are improving their profit margin per unit, reducing their capital requirements, and building a much more stable, recurring cash flow stream that isn't going to blow up their balance sheet if the rental market suddenly softens.
It takes a very confident management team to willingly crater their own top-line revenue growth in order to secure bottom-line stability.
It really does.
They are essentially telling Wall Street, look, we are going to look smaller on paper, but the money we do make is going to be pure risk-free profit.
And that discipline seems to carry over perfectly to their other non-housing segment, home renovation. Because this is where the story gets really counterintuitive.
Yeah, this part is fascinating.
In Q4, revenue for home renovation actually fell 12%. And for the full year, it only grew a meager 4.4%. But according to the commentary on the earnings call, this was not a failure of demand.
No, not at all.
Management deliberately put the brakes on this segment. They purposefully slowed it down.
Right. During the Q&A session, an analyst specifically asked about this phenomenon. The analyst noted that gross margins in the renovation business were actually improving, yet revenue growth was slowing down, which, seems backward.
Right. Usually if margins improve, you step on the gas.
Exactly. But CEO Stanley Peng's answer was an incredible look into the operational realities of scaling a physical business.
It honestly reminds me of a software company that realizes their new app is getting millions of downloads, but the code architecture is slightly flawed and causing memory leaks.
Oh, that's a good comparison.
Right. A bad management team just keeps buying server space to keep the app running and points to the vanity download numbers. But a great management team stops marketing the app, takes a full quarter to refactor the code and fix the bugs, and then resumes growth.
Yes.
Beike basically stopped opening new renovation projects to refactor their physical operations.
That is a highly accurate parallel. Peng explained that home renovation is fundamentally a delivery-heavy, high-risk business. It is not like flipping a switch on a digital platform.
It's atoms, not bytes.
Exactly. It involves supply chains, raw materials, physical labor, and really complex project management. If your underlying unit economics are not rock solid, growing the business aggressively is actively dangerous.
It just multiplies your problems.
Right. It multiplies your losses, your liabilities, and your customer service nightmares. He broke the costs of renovation down into two distinct categories: explicit costs and implicit costs.
Okay, let's break those down. The explicit costs are the line items you can easily model on a spreadsheet, right?
Okay.
It's the cost of the lumber, the floor tiles, the paint, and the hourly wages for the contractors.
Right. And Beike attacked those explicit costs aggressively by centralizing their procurement. They reported that they have now completed centralized national or regional procurement tenders for approximately 80% of their key materials.
Wow, 80%.
And 60% of their auxiliary materials.
So by acting as a massive centralized buyer, they bypass the local distributors entirely. They go straight to the manufacturers and say, hey, we will buy 1 million square feet of this specific tile. Give us the absolute floor price.
Exactly.
It squeezes the suppliers, reduces their exposure to local price volatility, and fundamentally lowers the base cost of every single kitchen they remodel.
So they fix the cost of the ingredients, but the explicit costs are really only half the battle. The real danger in home renovation lies in the implicit costs.
The silent killer.
The silent killers. Implicit costs are the financial and reputational drains that just don't show up on a standard procurement ledger.
Like what?
It is the cost of rework. It's when a contractor installs a custom cabinet crooked, the homeowner complains, and the team has to spend 3 days tearing it out, ordering new wood, and doing it all over again.
And you just wiped out the entire profit margin for that project.
Gone. Completely gone. Or it's the cost of upsell disputes, where a customer is quoted one price, but the contractor hits them with hidden fees, resulting in a really toxic customer experience.
And the most catastrophic implicit cost is the reputation damage to the broader Beike ecosystem, right?
Absolutely.
I mean, if a real estate broker on the Beike platform does a great job helping a young couple buy their first apartment.
Yeah.
But then the Beike renovation arm comes in and does a terrible, delayed, over-budget job fixing the bathroom. That couple is never going to use Beike again.
Never.
When they sell that house in 10 years, they will use a competitor.
Yeah.
When their friends ask for a recommendation, they will actively tell them to avoid Ike.
The stakes for failure in the physical delivery of renovation are so high that it can ruin the life cycle value of the customer for the core brokerage business.
So rather than risking the brand, Beike used 2025 to repair and validate the underlying profitability structure of the renovation arm.
They did. They introduced digital design tools to standardize the planning phase. They introduced modular product offerings so contractors aren't doing bespoke, untested builds every single time. And they implemented a strict certification and rating system for their delivery teams to reduce variance and enforce quality control.
So they are building a standardized, repeatable factory process for home renovation.
Exactly.
By deliberately sacrificing Q4 top-line growth, they ensured that when they do decide to step on the gas and scale this business up in 2026 or 2027, they know with mathematical certainty that every new project will be profitable.
And will enhance the brand's reputation rather than degrading it.
I mean, think about your own business, your own team, or even your own career for a second. It is incredibly tempting to chase vanity metrics. Growth always looks good on a quarterly report.
Oh, always.
But Beike's move here begs a really difficult question.
Yeah.
When is it actually smarter to put the brakes on your own momentum, take the heat from impatient observers, and fix a leaky foundation?
It requires a level of long-term strategic discipline that is very rare to see in a publicly traded company.
It really is. And a huge part of fixing those structural inefficiencies, both in the renovation business and in the core brokerage agent productivity we talked about earlier, relies on the integration of artificial intelligence.
Yes. Throughout the call, management repeatedly framed AI not just as an experimental tool, but as their new productivity engine.
And this is a topic we have to handle carefully, because right now, every company in the world is throwing the acronym AI into their earnings call transcripts to get a cheap bump in their stock price.
We use AI to optimize our synergy, right?
Exactly. AI synergy, whatever that means. But Beike actually laid out highly specific operational use cases. They aren't just bolting a chatbot onto their website. They are embedding AI into the core workflows of a property transaction.
The list of applications they are deploying is extensive and highly pragmatic. They are using AI for marketing content generation, like automatically pulling data from a listing to create video explanations and virtual tours.
Which saves the agents hours of work.
Right. They are using it for sales training simulations, allowing new agents to practice role-playing difficult customer negotiations with an AI before they ever talk to a real human.
That's fascinating.
And in the rental business we discussed, AI is making property acquisition decisions, recommending pricing models, and even identifying contract risks.
But what I found most fascinating was CEO Stanley Peng's philosophical breakdown of why AI is so necessary in real estate, specifically.
He had a really interesting take on this.
He pointed out that housing transactions are not standardized commodity purchases. It is not like going on Amazon and buying a blender, where the only variables are price and shipping speed.
A real estate transaction is arguably the most complex consumer purchase in existence. It is a long-cycle, multi-stage decision-making process.
It really is.
It requires navigating complex legal documents, securing massive financial leverage through mortgages, and coordinating multiple third parties. But more importantly, it requires a massive amount of emotional judgment.
His argument is that, historically, the real estate industry has forced human agents to be bad at two different jobs simultaneously.
How so?
Well, agents spend a massive amount of their time doing rational, repetitive, data-heavy tasks. They spend hours organizing property specs, drafting standard marketing copy, pulling neighborhood comps, and filling out boilerplate contract forms.
Right.
By the time they actually sit down with the client, they are too exhausted or simply lack the time to provide the deep emotional consultation and strategic advice the client actually needs.
And Beike's strategy is to use AI to completely bifurcate the workflow. They want to draw a hard line between rational tasks and emotional tasks.
The machines take over the rational.
Exactly. AI is infinitely better and faster at gathering information, matching demands, setting process reminders, generating documents, and running preliminary risk checks. AI is perfectly suited for tasks governed by clear rules and massive data sets.
I think about it like the dynamic between a paralegal and a trial lawyer.
Oh, that's a perfect analogy.
Right. The AI is the ultimate paralegal. It can read 10,000 pages of case law in 3 seconds. It can sort all the historical precedents, flag the relevant statutes, and organize the evidence into a perfectly indexed binder.
But you don't send the paralegal into the courtroom. to deliver the closing argument.
Exactly. The human agent is the trial lawyer. They are the ones who have to stand up in front of the jury, or in this case, sit across the kitchen table from a nervous first-time homebuyer, read the room, understand the unspoken anxieties, and make the emotional appeal.
That is exactly the dynamic Peng is describing. Because machines can process data flawlessly, but true judgment, explanation, and most importantly, trust still need to come from people.
Right.
Someone still needs to look that nervous buyer in the eye and say, I know the market is volatile and I know this is terrifying, but based on your family's specific needs, your commute, and your long-term wealth goals, this is a sound decision.
Because an AI algorithm cannot take accountability for a $1 million financial decision.
It can't.
If the market crashes or the roof leaks, you can't yell at an algorithm. A human has to shoulder that responsibility.
So Peng argued that rather than replacing the agent, AI will actually amplify the value of the human and emotional aspects of the job.
By freeing the agent from the drudgery of data entry and document prep.
Right. The agent is forced to evolve from a mere information middleman into a true strategic consultant.
This evolution raises a profound question, though, and it's one that Peng addressed head-on. As AI continues to advance and essentially commoditizes information, as it makes searching for listings, comparing prices, and drafting contracts effectively free and instantaneous for everyone, what is the ultimate limit of a platform's efficiency?
And Peng's answer to this was brilliant. He essentially argued that AI isn't the ceiling of efficiency, it's just the new floor.
Right. So he was saying the ultimate limit is still the human. Did I interpret that correctly?
You interpreted it perfectly. He argued that once the technological constraints are removed, once every brokerage has access to the same AI tools to sort the same data, the technology ceases to be a competitive advantage.
It becomes table stakes.
Exactly. Therefore, the ultimate limit of efficiency and the only true competitive differentiator left will be the capability, the empathy, and the strategic judgment of the service professionals themselves.
Taking that a step further, AI doesn't just empower the professional, it creates a massive, brutal divergence in the workforce.
Oh, absolutely.
The mediocre agents, the ones who historically only acted as glorified database searchers who just unlocked doors and handed out flyers, they will be entirely eliminated by AI. They offer zero value.
But the highly skilled agents,
The ones who act as trusted financial and lifestyle advisors, they will have their productivity amplified exponentially.
and that shift from information to advice ties directly into the final major theme from the earnings call, which revolves around how customers themselves are changing the way they make these massive emotional decisions.
The psychology is shifting.
Yes, the psychology of the Chinese home buyer is undergoing a radical transformation.
This came up during the Q&A session, right? When an analyst asked a really interesting question about the impact of self-media on property transactions.
Right. Self-media refers to independent influencers, key opinion leaders, and public accounts on short video platforms and social networks.
TikTok stars, basically.
Right. The analyst was essentially asking, are these influencers stealing your lunch? Are people bypassing traditional brokers and buying houses based on the recommendations of TikTok stars?
And management's response was incredibly revealing. They didn't dismiss it, and they didn't view it purely as a threat.
No, they viewed the rise of real estate influencers as a massive psychological indicator of where the broader market is heading.
Peng noted that this trend reflects a fundamental shift in the industry. Housing is moving from being a property-centered transaction to being a people-centered transaction.
To really understand that, we have to look at the psychology of a falling market versus a rising market.
Right, let's contrast those.
10 years ago, when Chinese real estate was booming and prices were going up 10, 15, 20% every single year, buyers were in a state of frantic FOMO fear of missing out.
The decision was entirely property-centered.
Entirely. The only questions were, is there a unit available and can I get the mortgage approved before someone else buys it?
Because the rising market forgave all mistakes.
It hid everything.
If you bought a house with a terrible layout, or in a bad school district, or with a slightly longer commute, it didn't really matter. 3 years later, the house had appreciated by 40%, and you looked like a financial genius. The asset itself was the only thing that mattered.
But today, with prices falling for 8 straight months and projected to fall further,
It's totally different.
the cost of making a mistake is absolutely terrifying. If you buy the wrong house now, you aren't just stuck with a bad commute. You are trapped in a depreciating asset. You are actively destroying your family's wealth.
The stakes are just monumental. Buying a home right now requires a careful reallocation of capital in a highly uncertain deflationary environment. Buyers are paralyzed by anxiety.
They don't just need to see the floor plan. They need intensive hand-holding and deep psychological validation.
I mean, think about the last major purchase you made. Maybe you were buying a new car or a high-end camera or even just a premium laptop.
Right.
You didn't just look at the spec sheet on the manufacturer's website and hit buy. You went to YouTube. You watched a dozen reviews from influencers whose opinions you trust.
You wanted to find a reviewer whose lifestyle mirrors your own.
Exactly. So you could watch them look at the camera and say, yes, based on how you work and travel, the battery life on this laptop makes it the right choice. You sought out emotional validation from a human being to reduce your own buying anxiety.
And that is exactly the psychological gap that real estate influencers are filling in China right now.
Customers are turning to self-media.
Right. Not just to look at highly produced drone videos of luxury living rooms, but for lifestyle validation and decision support.
They want an influencer they relate to.
Maybe a young mother or a tech worker to help them weigh the incredibly stressful trade-offs between commuting times, school district quality, and strict budget constraints.
So how does a massive publicly traded platform like Beike respond to that? They can't just hire 1,000 social media influencers to dance in front of apartment buildings and hope it drives sales.
No, but they have to adapt their workforce to meet the underlying psychological need those influencers are exposing.
Okay, how?
Beike's response is to forcefully evolve its agents into what Peng calls decision support consultants. Because while influencers are fantastic at providing broad perspectives and reducing initial anxiety at the top of the funnel,
They hit a hard wall when it comes to the actual transaction.
exactly. An influencer with 1 million followers isn't going to sit down with you to navigate the complexities of an escrow account, negotiate a price reduction based on a bad inspection, or ensure the title of the property is legally clean.
The influencer has reach, but they lack execution capability and risk management.
Right. Beike's goal is to combine the content appeal, the empathy, and the emotional resonance of an influencer with the rigorous execution, legal compliance, and trusted infrastructure of a regulated platform.
They want their agents to be the trusted advisors.
The ones who not only understand the client's deep personal anxieties about the market, but also have the institutional backing to actually close the deal safely and legally.
It is an incredible evolution to witness. I mean,
Yeah.
we started this show looking at a company facing a brutal 30+% drop in its core transaction volumes.
Yeah, top-line revenue miss.
Right, in a macroeconomic environment that looks incredibly bleak for years to come.
But underneath the hood, once you peel back the layers of the income statement and look at the operational plumbing, we discovered a platform that is not just surviving, but actively redesigning itself for a new era.
They're maintaining investor confidence through aggressive capital discipline, using a fortress balance sheet to deliver massive cash returns to shareholders.
They are rapidly diversifying into non-housing revenues like rentals and renovations.
While demonstrating the discipline to sacrifice top-line growth to ensure bottom-line profitability.
And perhaps most profoundly, they are completely reimagining the role of the human worker in an automated world.
By using AI to handle irrational data processing, they are forcing their human workforce to elevate into roles of high-level emotional judgment and complex decision support.
They are betting that in a world of infinite information and terrifying market uncertainty, the most valuable commodity left is human trust.
Which leaves us with a broader philosophical question for you listening. One that extends far beyond the Chinese real estate market and touches every single industry.
As artificial intelligence continues to infiltrate your workflow, it will inevitably commoditize the basic information you process every day.
When the data you use to organize and sell is suddenly abundant and worth zero, what is left? Will your career or your business be able to pivot
Will you be able to stop acting as an information middleman?
and successfully transition to selling trust, accountability, and emotional support? Because if the Beike earnings call tells us anything, it's that the future belongs entirely to those who know exactly what the machines cannot do.
Well said.
All right, before we wrap up this deep dive on talk tickers, it is time for our favorite segment. This is not financial advice.
Because it literally isn't.
Right. We are just two people analyzing earnings transcripts into microphones. But if you had to take all the insights from this deep dive and formulate a completely outrageous yet structurally plausible trade idea, what is the play here?
Okay, here is the outrageous talk tickers paired trade. Based on the idea that Beike is transitioning from a housing beta to a highly efficient tech and services platform, you go synthetically long on Beike stock.
Okay.
You are betting that their capital returns and AI-driven margin expansion will continue to support the equity even if housing turnover stays flat.
Okay, long bake. But it's a paired trade, so what are we shorting to hedge the macro risk?
You short the physical cement and glass.
Oh, wow.
Yeah, you take a short position against a basket of traditional, highly leveraged Chinese property developers who are entirely dependent on nominal capacity and new project starts.
They're the ones trapped in the old scale-driven era.
Right, holding massive land liabilities while prices drop.
I see where you're going, but let's make it spicier. If the future is all about the emotional connection of self-media and trusted advisors, what if you shorted the pure-play digital marketing agencies in China that rely solely on programmatic ad buys for real estate?
Now that is interesting. You are essentially betting on the trial lawyer over the billboard. You go long the platform that is integrating AI and human trust, and you short the middle-tier marketing firms that provide nothing but the raw information that AI is currently making worthless. It's an aggressive play on the total reorganization of the real estate value chain.
I love it. A long position on platform efficiency and human trust, and a short position on legacy infrastructure and commoditized data.
Plausible, outrageous, and entirely not financial advice.
Thank you for joining us on Talk Tickers. Keep exploring, keep questioning the numbers, and we'll see you next time.